Today, we're diving into a fascinating, high-risk, high-reward explainer on the medical device sector. The spotlight is on Tenon Medical. They've got serious commercial momentum, but they're also fighting a massive ticking clock. Let's get right into it.
So Tenon Medical, trading under the ticker TNON. They're a microcap medical device company, and they are hyper-focused on one very specific niche, sacroiliac or SI joint fusion. If you follow this space, you know SI joint dysfunction is a notoriously tough cause of lower back pain, which means there's a massive market opportunity for whoever actually figures out how to solve it effectively. Tenon is tackling this with a less invasive approach. They started with their catamaran system, and now they're rolling out their next-generation SImmetry Plus system. Now, right out of the gate, we need to be crystal clear. This is not your mature blue-chip investment. Tenon is a pure commercialization story. They are aggressively trying to carve out their own space in a highly complex orthopedic market.
Okay, so let's start with the bull case, which is heavily anchored by some undeniable commercial momentum. Look at this top-line trajectory. You can literally see genuine, measurable improvement happening right now. Back in 2021, revenue was just $160,000. Fast forward to 2023, it jumps to nearly $3 million. And in 2025, they posted $3.94 million. That's about a 20% bump over the previous year. And honestly, the momentum seems to be accelerating. In the first quarter of 2026, revenue hit $1.38 million. That is up almost 90% year over year, which pushes their trailing 12-month revenue to around $4.6 million. For a microcap, scaling this fast from a tiny base proves that their products are definitely getting real traction out there. But, we can't confuse rapid growth from a tiny baseline with proven sustainable scale just yet.
And here is a number that brilliantly shows why the bulls are paying such close attention: 69%. That was Tenon's gross margin in the fourth quarter of 2025. Overall gross profit for the year was roughly $2.4 million, which is up 38% year over year. Now, in the medtech world, if you have high gross margins, recurring procedure demand, increasing surgeon adoption, and a differentiated product, well, you've basically found the holy grail. Think about it. Once those initial R&D and commercialization costs are covered, high gross margins mean almost every new dollar of revenue drops straight to the bottom line. If Tenon can survive long enough to reach critical scale, that operating leverage is exactly what the bulls are betting on.
But here comes the reality check. This is where the profile violently shifts from promising to extremely speculative. We have to look at the other side of the ledger. Yes, Tenon generated that $3.94 million in 2025 revenue. But they also recorded a staggering net loss of roughly $12.56 million. On top of that, their trailing 12-month free cash flow was a negative $11.55 million. So what does this tell us? It means that despite all that great revenue growth we just talked about, this company is heavily, and I mean heavily, dependent on external capital just to keep the lights on. This massive, unsustainable loss profile is, without a doubt, the single biggest risk sitting on their plate today.
And that unsustainable loss leads right into a huge red flag on the balance sheet. Let's break down the data from March 2026. The company held about $4.61 million in cash and investments. Against that, they've got $4.88 million in total debt. So net debt is sitting around $270,000. Now, let's do the actual survival math here, because it's pretty sobering. Compare that $4.5 million or so in cash to their estimated annual free cash flow burn of $11.5 million. They are burning nearly $1 million a month. That means their existing cash pile gives them less than 6 months of runway. The math just flat out doesn't work without either a massive financing injection or some immediate, almost miraculous improvement in their cash generation.
Because that cash runway is so terrifyingly short, dilution goes from a maybe to a severe, impending reality. Tenon has already stated they need about $7.15 million in financing for their 2026 growth plans. And the equation here is brutal for current investors. Higher revenue plus high gross margins combined with ongoing massive operating losses equals an absolute, undeniable need for more capital. If management can't rapidly improve their operating leverage, microcap shareholders are staring down some pretty devastating consequences. We're talking secondary offerings, warrants, convertible securities, and the dreaded reverse splits. In the microcap space, these mechanisms are incredibly toxic. They can easily trap early investors, meaning you could absolutely lose your shirt on this stock even if the underlying business ultimately succeeds down the line.
Which naturally leads us to valuation. And valuing a deeply unprofitable company is always notoriously tricky. If you just glance at standard metrics, the stock looks incredibly cheap, trading at a price-to-sales ratio of around 0.7x. You might look at that and think, wow, I've stumbled onto a deep value bargain. But hold on, there is a massive caveat here. A low price-to-sales multiple does not automatically equal undervalued. Think about it. If TNON keeps burning over $10 million a year while only pulling in $4 or $5 million in revenue, that 0.7x multiple is probably just the market being highly efficient and pricing in that extreme risk of future dilution. You literally cannot value this thing based on today's earnings. You have to model out their future revenue against some very harsh cash burn scenarios.
So how exactly does Tenon escape this trap? Well, it all hinges on one make-or-break fundamental catalyst, their next-generation SImmetry Plus system. Now, the good news is they've already secured FDA clearance, which is fantastic because it removes a major regulatory hurdle right off the bat. They've also started initial procedures at some centers of excellence. But here's the thing, the narrative has completely shifted. In medtech, getting an approved product is honestly the easy part compared to actually changing a surgeon's entrenched workflow. The ultimate pivot point for this stock is no longer, will the FDA approve it? Instead, it's will surgeons actually adopt this thing at massive scale?
To figure out if a SImmetry Plus can actually transition Tenon from a speculative gamble into a genuine growth story, you've basically got to put on your venture capitalist hat. You need to aggressively monitor some very specific operational metrics. First, you've got to watch the number of surgeons actively adopting the system and the total procedure volume. But even more crucially, look for repeat utilization. A surgeon trying a device once is just a trial run. A surgeon coming back a second and a third time, that means the clinical outcome was genuinely superior. You also need to track gross margin stability. Keep a close eye on that 69% figure we mentioned, along with revenue per procedure, sales force productivity, and how fast they're acquiring new hospital accounts.
And we can't ignore the battlefield they're stepping onto. It is going to be an intense uphill fight against the broader competitive landscape. Ten's main edge here is their niche specialization. They are hyper-focused exclusively on the SI joint market, which gives them advantages in specialized product design, a perfectly optimized procedural workflow, and highly specific intellectual property. But their lack of scale is a massive disadvantage. They are going toe-to-toe with large medical device companies that have overwhelming financial resources, massive R&D budgets, and deeply entrenched hospital relationships. These giants can easily bundle their products to hospitals at steep discounts. What that means is Tenon's SImmetry Plus system can't just be good, it has to provide pure clinical superiority to overcome the massive moat created by their competitors' sheer scale.
When we map all of this out onto an investment scorecard, the duality of Tenon is visually striking. Revenue growth and product opportunity, a very solid 4 out of 5 stars. Gross margin, also a great 4 out of 5 stars. But then you look at profitability and cash flow, and it's a dismal 1 out of 5. The balance sheet is incredibly weak at 2 out of 5, and the dilution risk is at absolute maximum severity. So what you have are these fantastic top-line metrics that are being dragged underwater by terrible cash flow, leading to an overall risk rating that is flashing bright red. Make no mistake, this is a very high-risk proposition.
Which brings us to the final verdict of this explainer. I would absolutely not classify Tenon Medical as your conventional buy-and-hold long-term investment. This is strictly a venture capital-style bet being placed in the public markets, suited only for highly aggressive investors looking at a very small speculative position. Microcaps with this exact financial profile, they rarely just trade sideways. They either break out exponentially or they collapse completely under the weight of dilution. Because their current market cap is so tiny, if they do hit that bull scenario, growing revenue fast, keeping margins high, and lowering operating expenses, the upside is absolutely enormous. As the core analysis puts it, the stock has genuine multi-bagger potential, but it also has genuine near-zero and dilution risk. The opportunity is real, but so is the danger.
And that leaves us with the ultimate, high-stakes question for the next 12 to 24 months. The question isn't really whether Tenon can grow revenue. We've seen that they can. The real question is, will SImmetry Plus grow fast enough to turn Tenon's excellent gross margin profile into positive operating cash flow before the company runs out of capital and is forced into punishing dilution? It is quite literally a race against the cash burn clock. So what do you think? Can they beat the clock? Keep a hawk's eye on those adoption metrics because that right there is the absolute make or break issue for TNON.